Yesterday, I found that you are facing some difficulty in hedging of foreign risk. So today, I thought of discussing about the hedging of foreign risk. So that if you have this knowledge, then it will be easy when you are going for the case. So can we have a discussion on this hedging of foreign exchange risk?
Yes, sir.
Yeah. So yesterday case, if you remember, a supplier who is trading with a foreign company, so he applied the different sources of minimizing his foreign exchange risk. So, so that's why today we'll try to have a discussion on this.
Okay, sir.
Now, especially in foreign exchange risk, we'll be having majorly three type of risk. One is transaction risk, and the other one is economic risk, and next one is translation risk. Transaction risk, economic risk, and translation risk. Suppose if you see the transaction risk, suppose if any risk uh, occurs, suppose here you can see the risk of change rates changing between the entering into a transaction and settlement date. Nothing but the fluctuations in the exchange rate between the transaction date and the settlement date. Suppose, let me give an example. When it comes to the transaction risk, on 1st January 2020, a company, X company, entered an agreement with Y company of UK. So when they entered on that particular day, let us assume that one pound is equal to 100 rupees. But the settlement, the transaction will be settled in a future date. Let us assume that it will be settled after 2 months. So the fluctuations in the exchange rates between this particular period is considered as transaction risk, because on 1st January 2020, as I said, the exchange rate is 100 rupees for 1 pound. Now, on the settlement date, if you are expecting an increase in the exchange rate, so whatever risk which is associated with that particular fluctuation or with that particular increase should be considered as transaction risk. I hope transaction risk is clear, or you want me to give one more example on this?
Clear, sir.
Yeah. And the other one is economic risk. Suppose if you see the economic risk, so the risk of the value of a firm being affected by long-term trends in the exchange rates. So here mainly you need to focus on the long-term trends. If the long-term trends in the exchange rates means, if let us assume that if there is any frequent fluctuations in the exchange rate over a long period of time, suppose let us assume that in the previous year, we assume that the frequency of change in the exchange rates of the currency of a nation is very high. And if it try to continues over a particular period of time, here the long term means generally if it is more than 12 months. So we can consider 12 months period as a criteria for considering it as a long term. So if it is more than 12 months, if the fluctuations continues for a period of more than 12 months, then we can consider it as a long-term trends in the exchange rates. So because of this particular long-term trends in the exchange rates, if the value of the firms, if it affects the value of the firm, then we can consider it as a economic risk. So I hope economic risk is also clear. Please let me know if you have any doubt on this economic risk. Yes. Yes, Manal, I hope you understood the transaction risk and economic risk. Yeah, Malan, am I audible? Yes. Now, when it comes to translation risk, now the risk associated, the risk which is associated with the exchange rates relating to the assets and liabilities. Because yesterday, if you remember, we had a discussion of a foreign subsidiary. Now, when you are disclosing the values of assets or liabilities regarding the foreign subsidiaries, and if the impact of exchange rates is high on the disclosure, then it considered as a translation risk. Suppose here you can see the risk that foreign subsidiaries assets and liabilities will appear to change. Suppose, let me give an example. For the financial year 2019 and 2020, we showed the value of a particular asset, and let us assume that the foreign subsidiary is USA. Now, and the parent company is India. So, the parent company is following the Indian currency, we are following the rupees, and the subsidiary is a US based company. So, the subsidiary currency is dollars. Now, let us assume that for the financial year 19 and 20, we showed an asset value after converting into the parent company currency, that is rupees, as 1 lakh. Once again, I repeat. So, we are having an Indian company is having a foreign subsidiary. For the financial year 1920, we showed the asset of that particular foreign subsidiary after converting into the parent company currency as 1 lakh rupees. So, when we converted during that time, let us assume that $1 is equal to 70 rupees. On the day of conversion, on the day of that particular, when we are disclosing that in the financial statements, it is 70 rupees. Now, I think you might be knowing whenever we are dealing with the assets, every year it is mandatory to revalue, especially if it is a multinational company, all the assets need to go for revaluation every year. Now, same in this case also, for the next reporting year, when we are revaluing it, the exchange rate differs, because in 1920, for 2019 and 2020, as I said, $1 is equal to 70. But for the next reporting year, the $1 value increased to 73 rupees. Now, in that case, it will be difficult for the parent company to show these values in the financial statements. So, the risk which is associated with this kind of exchange difference is considered as a translation risk. So, generally, this translation risk is associated with the foreign subsidiaries. So, the parent company will be having a different currency and the foreign subsidiary will be having a different currency. If you remember, yesterday I already mentioned, always we need to consider the parent currency only. It means foreign subsidiary values should be converted to the parent company's currency, and that should be disclosed in the financial statements. So, if any risk associated with this effect, that should be considered as a translation risk. Is this clear, translation risk? So, I'm expecting both. Please let me know whether you understood these three or not. Translation, transaction, economic, and translation risk. Now, we'll discuss how to hedge the transaction risk. Don't confuse between the translation and transaction. Okay. So, how we can hedge the transaction risk? Sorry. Now, when we are dealing with the transaction risk, if you are using the internal methods, if you are using internal methods to hedge the transaction risk, hedge is nothing but minimizing the risk. So, how we can minimize the transaction risk? By using the internal methods. So, we can minimize it by invoice in the home currency. The first internal method which we can use to minimize the transaction risk is by invoicing it in the home currency. And the second thing is leading and lagging. And the next one is foreign currency bank accounts. If we can have a foreign currency bank account, that also we can use to minimize the transaction risk. And the next one is matching. Now we try to discuss in detail. First one is invoice in home currency. Any idea what you understood about this? Invoice in home currency means? So we invoice in home currency, we are considering it as an internal method to minimize the transaction risk. What exactly it means? Invoice in home currency means? Suppose, let me give an example so that you can understand. Yeah. X Limited of India, X Limited of India sold goods to Y PLC of UK, a Y company, a UK, Y of UK company, Y of UK. Now let us assume that X sold goods, X Limited of India sold goods to Y of UK. Now, because it is a for UK, it is a foreign transaction, so definitely there is a chance of transaction risk. Now, how we can minimize is by invoicing it in the home currency. Invoicing it in the home currency means here X company is selling the goods. X company is selling the goods. Now, if they can prepare the invoice in Indian rupees, if they can prepare the invoice in Indian rupees, because the party who is selling the goods can prepare the invoice. In this case also, if the X Limited company, in order to minimize this transaction risk, if they can raise the invoice, if they can prepare the invoice in Indian rupees, then definitely they can minimize the transaction risk, because the other party will be having the risk of exchange. Now, this particular seller won't be facing any transaction risk in this case, because he prepared the invoice in the home currency. Here, home currency is nothing but rupees. I hope this invoice in home currency is clear. So it means if you invoice in the home currency, you are passing the exchange rate, transaction risk to the other party, that is to the purchaser. So that's why we can consider this invoice in the home currency as one of the internal method to minimize the transaction risk. So let me know whether you understood this invoicing in home currency. So the next concept is matching. Yes. Now we can consider this matching as one of the internal method. Now in case of matching, what we'll be doing is, if we can have an equivalent, suppose let us assume that same example will continue. X company sold 1 lakh rupees 1 lakh rupees worth of goods to UK company. Now, as I said, there is a transaction risk. Now, how they can minimize is, if the same amount, if they can have another transaction with the same amount. Suppose it means that if X company purchased any equivalent amount of goods from the foreign company, in that case they can match it. It means if a sales and a purchase, if a foreign purchase and a foreign sales, if we can match the foreign purchase and a foreign sale, that we can use it to minimize the transaction risk. Suppose let us assume that X purchased the goods. Now in this case, We are discussing from the purchaser point of view. Now, X purchased the goods. Let us assume that on 1st January 2020, and he is liable to pay the amount after 3 months. So on the day of agreement, it means on 1st January 2020, $1 is equal to 70 rupees. But after 3 months, he is expecting an increase in the dollar value. So he is expecting an increase in the dollar value. So definitely it is a transaction risk. Now how he can minimize is if he can enter a sale transaction with an equivalent amount. Suppose if he can enter a equal sale transaction with a foreign customer. Suppose here let us assume that the value of purchase is $1,000. We'll assume that the value of purchase is $1,000. Now, how we can minimize that? If we can enter a sale transaction with $1,000, then he can minimize it. It means here he is having a period of 3 months. So he is expecting an increase in the dollar value within 3 months. So by using this matching concept, he can minimize that particular transaction risk. But practically it is very difficult. So we cannot practically apply the matching concept for minimizing the transaction rates because it is very difficult to find a buyer or a purchaser with an equivalent denomination of foreign currency. So that's why practically it is very difficult to go with the matching concept. But matching concept says is a foreign purchase should be matched with a foreign sales so that we can minimize the transaction risk. So I hope you understood the matching concept also. Or you want me to explain once again? Yes, Manal, I'm not getting a reply from you. If you have any question, means you can ask me on this. Again, once again, I will explain. Yeah. And the next method is leading and lagging. Now, leading and lagging means first we'll discuss about the leading concept. First, we'll discuss about the leading concept. Yes. Suppose, hello. Hello. Yeah. So leading means, yeah, same example. Let us assume that on 1st January 2020, I purchased a product from the UK company, US company, and on the day of purchase, the value of exchange rate is 70 rupees for $1. Now I got a credit period of 2 months. It means I can repay the amount in a span of 2 months. But I am expecting an increase in the dollar value. Suppose if the dollar value increases as a purchaser, definitely it will be a loss to me. So definitely I will be exposed to transaction risk. So what I can do is I can request the seller for early payment. It means instead of suppose example, if I entered an agreement on 1st January 2020, actually my due date is to pay the amount on 1st March 2020. But what I'm expecting is after 10th February 2020, the dollar value is going to increase. This is my expectation. Now what I can do, I can request the seller and I can take a lead and I can make the payment before 10th February so that I won't be exposing to the transaction risk. So that is nothing but leading. Leading means repaying the amount before the due date. Simply how we can understand leading means repayment of the amount before the due date. So actually the due date is 1st March, but we are expecting that after 10th February, there will be an increase in the dollar rate. So that's why we can request the seller, and if we can repay the amount before 10th February, then we won't be exposing to the transaction risk. So this concept is known as leading. Now completely opposite to the leading concept is lagging. Now I am expecting you to say this. If you can, if you understood the leading concept, you can easily analyze, you can easily say the lagging concept. Completely contrast to the leading concept. Can I expect from you what lagging means now? So lagging concept is, as I said, it is completely contrast. It is opposite. So in this case, the given example, sorry. So as I said, we've entered an agreement on 1st January 2020, and my due date is to pay the amount on 1st March 2020. But I am expecting that there will be a increase in the dollar rate between the period of 10th January to 1st March. And after 1st March, I am expecting that there will be a decrease in the dollar value. It means whatever the exchange rate which was prevailed on the agreement date, same rate I can expect after 1st March. But my due date is 1st March. I need to repay the amount on 1st March. But I am expecting that the exchange rate will normalize after, because I am expecting that within these two periods there will be a significant fluctuations in the exchange rates, and I am expecting that it will be normalized after 1st March. But due date is 1st March only. Now in that case, we can request the seller to extend the credit period. Suppose if the credit period, if the due date is on 1st March, we may request the seller to extend it up to 10th March, because after 1st March we are expecting that the exchange rate will normalize. So this process is known as lagging. So lagging in a simple way, requesting the seller to extend the due date. And leading is nothing but requesting the seller to give an option to repay the amount before the due date. So clearing the settlement or making the settlement before the due date is known as leading, and making the payment after the due date is known as lagging. So I hope you understood the lagging concept. And the other method is foreign currency bank accounts. So I don't think I need to give an explanation on this. So simply, if we can have a foreign currency bank account, we can utilize that to repay the settlement. Suppose in this case also, if X company, if they can open a foreign currency bank account, it means if they can open a bank account in a foreign country in their currency, then they can use it to minimize the transaction risk. So these four are the internal methods which we can use to hedge the transaction risk. So I hope all these four internal methods are clear to you. Now the next concept is external methods. Now, what are the available external methods which we can use to hedge the transactions? Nothing but to hedge the transaction risk. One is forward contracts. So here, forward contract, if you remember our yesterday session, what I said, a present agreement for a future transaction. So we can use forward contract. It means in the given example, in order to minimize the transaction risk, X company can enter into a forward contract on the currency. and they can use this foreign contract to minimize the transaction risk. But do remember, these forward contracts are possible only through OTC. We can't go with the forward contract with exchange traded. So if you can remember the difference we discussed yesterday when we were discussing about the case. So OTC means over the counter. It means stock market will not be involved for the transaction regarding these forward contracts. So we can use the forward contracts as a external method to hedge the transaction risk. So forward contracts are done only through OTC, that is over the counter. Is this clear?
Yes, sir.
So here if you see, under a forward contract, a firm agrees to buy or sell a fixed amount of currency at a predetermined rate on some fixed future date. So generally the forward rate is set by the bank using the interest rate parity. So this particular forward rate is set by the bank using the IRP, interest rate parity theorem. If you remember, we discussed that IRPs. Two theorems are there, purchase power parity and interest rate parity. So if you understood this, a firm agrees to buy or sell a fixed amount of currency at a predetermined rate on some future exchange or at a fixed future date. Suppose in this case also, if X purchased 1 lakh worth of products from a US company and the due date is after 2 months. Now in order to minimize the transaction risk, what he can do is he can purchase an equivalent amount of forward contract, and nothing but he can purchase an equivalent amount of foreign currency at a predetermined rate. Suppose, let me give an example so that you can understand. So on 1st January 2020, X purchased the goods worth of $1,000. On this particular date, let us assume that $1 is equal to 70 rupees. But he need to settle the transaction on 1st of March 2020. He need to settle the transaction on 1st of March 2020. Now in this case, what he's expecting is, in this span of 2 months, it means on 1st March 2020, he is expecting that the dollar weight goes to 73. He is expecting that the dollar rate will increase to 73. So definitely, according to his expectation, if the dollar rate increases to 73 means definitely it will be a loss to the purchaser. Now what he can do is, on the same day, it means that on the agreement date, on 1st January 2020, he can purchase the foreign currency at a specific rate. It means that on 1st January 2020, the foreign currency value $1 is equal to how much? 70 rupees. Now, if he can purchase this particular forward contract, which after a period of 2 months, because present he entered a contract, present he entered into a forward agreement at a future specified rate. Now, in this case, if he can if he can purchase a foreign currency at 70 rupees after 2 months, it means that on 1st March 2020, he will be getting that particular dollars at 70 rupees only, irrespective of the prevailed market price. So on 1st March 2020, if a dollar rate goes to 73 also, but he will be having an opportunity to purchase that particular currency at 70 rupees only. So these kind of agreements is known as forward contract. Is it? Are you clear with this, or you want me to explain the example once again?
It's clear, sir. I understood.
So this is about the forward
Forward.
contract. Okay. And usually this particular forward rate is fixed by the bank by using the interest rate parity. Interest rate parity means how they will be calculating interest rate parity means, here in the given example, we are discussing about the two countries. One is India and the other one is USA. So we'll take the prevailed interest rate in USA and we'll also take the interest rates in India, and accordingly we'll calculate this particular forward rate by using the interest rate parity. Interest rate parity means considering the prevailed interest rates of the countries. So we'll take the interest rate of USA and we'll take the interest rate of India. And by using those interest rates, we'll try to calculate the forward rate, because interest rate parity theorem says that the exchange rate of an economy mainly depends upon the interest rates in an economy. So the exchange rates is directly related with the interest rates of that particular economy. So if there is any significant increase in the interest rates, if the interest rates are significantly increased in an economy, then we can say that their exchange value will increase, the exchange rate will decrease, exchange rate will increase, sorry. So as per the IRP theorem, the exchange rate of an economy is directly related with the interest rates prevailed in that particular economy. So in this forward contract also, we will use the IRP for calculating the forward rate. I hope forward contracts are clear.
Yes, sir.
And the next external method which is available to hedge the foreign exchange risk is money market hedges. Now here try to understand this. So generally we can say it as MMCs. A money market hedge eliminates the risk by ensuring that currency is translated immediately at the spot rate. Suppose the example which we are continuing, that is the payment in future. Nothing but in this case we are dealing about the X who purchased goods from a foreign company and he need to make the payment in future. So how we can use if you are making a foreign currency payment in future by using this particular money market hedge. Now what it says is the first step is we need to borrow the home currency. We need to borrow the home currency and exchange it with the foreign currency now. Suppose let us assume that in this given example, Mr. X need to pay $1,000 on 1st March 2020 because agreement is done on 1st January and he need to make the payment on 1st March. So in order to eliminate the transaction risk, what he can do, first he need to borrow the currency in the nothing but he need to borrow the money in the home currency, that is in Indian rupees, and that money should be converted into the foreign currency, and that foreign currency should be deposited. Suppose in a simple way, how much I need to pay after 1 month? $1,000. Now on the day of agreement, if the dollar rate is 70 rupees, how much I need to borrow? 70,000 I need to borrow. So that 70,000 I need to borrow and I will convert it into $1,000, and the $1,000 will be deposited in the foreign currency. And on the day of repayment, simply we can use the foreign currency to make the repayment. So this is nothing but money market hedge if you are making a payment. Is this clear?
Yes, sir.
May I explain once again?
Okay, sir. One more.
Yeah. Suppose in the given example, X company purchased products from USA on 1st January 2020 and they need to make the repayment on 1st March 2020. So because we are company is dealing with a foreign currency, there is a chance of transaction risk. Now how the company can use the money market hedge is agreement is done on 1st January 2020. So on the same day, X can borrow an equivalent home currency, because in this case the $1,000, if you convert, suppose on the day of agreement, if the dollar is 70 rupees, an equivalent 70,000 rupees can be borrowed and it should be converted into the currency. That's what $1,000 we will be getting. So that on the same day, the $1,000 should be deposited in the foreign currency. You can use any of the Exim bank where we can deposit the foreign currency. And on the day of due date, we can withdraw the amount and we can make the payment. So this is from the purchaser point of view, if you purchase any foreign product. Now, when it comes to the seller point of view, nothing but if we need to receive any amount in future, suppose we'll try to discuss an example for this also. X sold 1 lakh worth of goods to Y of USA. X sold 1 lakh rupees. Here I am mentioning about rupees. X sold 1 lakh, nothing but, or if the transaction is done in foreign currency only, suppose if the X sold 1 lakh dollars on 1st January 2020 to Y of USA. It means that, and he gave a credit period of 2 months. So on 1st March, he need to get an exactly $1,000 from Mr. Y. But he is expecting that the dollar value will decrease. So today when the transaction was done, $1 is equal to 70 rupees. But X is expecting that on 1st March 2020, $1 will be only 65 rupees. If the $1 is 65 rupees means definitely it is going to affect. So it is definitely affect the receipts of the X Limited company. So in that case, what he can do is borrow the foreign currency, completely reverse to this, if you can observe this. In case of payment, we will be borrowing the home currency and we are converting into the foreign currency. But when we are dealing from the seller point of view, we need to borrow the foreign currency and it should be converted into the home currency and deposit the home currency into the just into the bank and use the eventual receipt to pay off the foreign borrowings. Is this clear about the receipt in future? So first payment in future is from the purchaser point of view and receipt in future is nothing but the seller point of view. So this strategy, this concept is nothing but money market hedge. So money market hedge says that just borrow the required amount which can be used to settle the transaction.
I understood, sir.
Now the next external method which is used to hedge the transaction risk is future contracts. So do remember, future contracts and forward contracts are same, but the major difference between forwards and futures is forward contracts are done through OTC platform, that is over the counter, but future contracts are done through stock market, nothing but stock exchanges. So these future contracts are exchange traded and forward contracts are OTC traded. So that is a major difference between these. So here you can see a future contract is like a forward contract, fixes an exchange rate at some future date. And future contracts are standard sized derivative products which are traded on exchanges. The point which I just now mentioned. These are traded on the exchanges. So standard expiry dates, the end of March, June, September, December. In this case of especially when it comes to the forward contract, there will not be any standard expiry date. According to the requirement of the participants, they can fix their own expiry dates. But in case of future contract, we won't have the flexible expiry dates. Here there will be having the standard expiry dates, like maybe generally end of the March, June, September or December. So these future contracts are available for a standard, they will be having a standard expiry date, 31st March or 30th June or 30th September or 31st December. But when it comes to the forward contracts, those are flexible expiry dates are available for forward contracts. According to the requirement of the participants, they can fix it. But that option is not available for future contracts because these are traded through a stock exchanges. So that's why the flexibility is missing regarding these future contracts. And the future price represents the expected exchange rate on the contract expiry date. So same concept as per the forward contracts. On the future price represents the expected exchange rate on the contract whenever the contract expiry date is there. So what is the expected exchange rate on that particular expiry date? On that particular basis, future price will be fixed. So both are identical only. The only difference is those are OTC traded, these are exchange traded, and there will not be any what is the flexibility of expiry date is available in case of forwards. Same is not available for futures. So these are the major two difference between the forward currency contracts and future currency contracts. Any questions you want to ask for these future contracts?
No, sir, no questions.
So how we can set up this future hedge? So first we need to decide, do we initially buy or sell futures, whether you want to buy the futures or whether you want to sell the futures. So identify the currency of the contract. So which currency you want to contract, whether it is dollars or pounds or rupees or any other currency. And do the sum to the future that we plan to do to the CC to our transaction. Suppose example here you given, if the contracts have a standard size of 62,500 sterling, the CC will be sterling. If a UK company expects to receive dollars and have to buy pounds, then it must be buy future. This is very, very important thing. Suppose in the given example, here the currency of the contract is sterlings, or we can say it as pound. If a UK company expects to receive dollars and have to buy, suppose expects to receive dollars and have to buy pounds, then it must buy the futures. Is this point clear, Ramna?
Yes, sir. It's clear.
Yeah. And after deciding this, the next step in setting up the future hedge is how many contracts, because it depends upon the contract price, how many contracts we need to go with. So how many contracts we need to go with. So how many future contracts we need to purchase so that the total what is this agreement amount can be paid or received. And the next step in this setting up of future hedge is which expiry date. So pick the first to expire after the transaction date. So this is the most important thing. Pick the first to expire after the transaction date. Now, what you understood by this, here if you remember, especially in case of future contracts, let me show it. It will be generally March, June, September and December. 31st March, 30th June, 30th September and 31st December. Now, how we need to choose the expiry dates is, suppose, let us assume that if your due date, suppose, if your agreement date or if your transaction date is 1st January 2020, the agreement date is 1st January 2020, then you need to select the first expiry date. The first expiry date will be, what is the first expiry date? Can you say? If your agreement date is 1st January 2020, now how we can select the expiry dates? So the expiry date which is immediately available after your transaction date. If your transaction date is 1st January 2020, then what will be the expiry date which we need to go? If you are making a transaction on 1st January 2020, Now, if you are making a transaction of 1st January 2020, always give preference to the first expiry date. In this case, the first expiry date will be 31st March. So we need to select the future contracts which will expire on 31st March. And if your transaction date, let us assume that if it is on 10th March, then we need to select the future contract which expires on 30th June. And if your transaction date is, let us assume that 1st July, then we need to select the future contract which expires on 30th September. So like this, we need to go with this. So pick the first to expire after the transaction date. Okay. So these are the setting up of future hedge. First, we need to decide initially what exactly you want to buy or sell. So we need to identify the CCs. CCs are nothing but currency of the contract. After deciding the currency of the contract, then we need to decide the quantity of the contract which we need to purchase. So always do remember, when we are selecting the quantity, nothing but the number of the contract, it should exactly match the amount which you need to settle the transaction. So that is nothing but the quantum or the quantity of the contracts. So after selecting the quantity of the contract, then we can go for the future contracts with the different expiry dates. So when we are selecting this, so the future contract which expires immediately after your transaction date, that should be selected. Is this clear?
Yes, sir, it's clear.
Next, currency futures. Now here the aim of the currency futures hedge is to fix the exchange rate, and once again I am repeating, the aim of this particular currency futures hedge is to fix the exchange rate, and the rate should be fixed at opening the future price or opening future price plus unexpired buyers on the transaction date, and generally this we can also say it as a lock-in rate. So the lock-in rate, how we can fix this particular lock-in rate is opening future price and unexpired basis on the transaction date. Nothing but let us assume that what is the available futures on the day of your transaction date, and unexpired means, suppose let us assume that the transaction date is 10th January 2020. 10th January 2020. Now, the opening, in that case, the future, the options which is available to me is, that is March. Now, in that case, we need to calculate the price of that particular option on the, it means on 1st January. Generally, if you remember, especially the maximum due date or maximum duration in case of futures is 3 months only. So maximum duration for futures is only 3 months. So it means in this case also, the futures which expires on 31st March, its due date will be 1st March. Sorry, its due date will be 1st January. So 1st January to 31st March. Now in this, the given example, you are making the transaction, you are entering into the transaction on 10th January 2020. Now in order to fix the rate, what we need to do, we need to select the price of the option on 1st January. To that particular opening price, we need to add the price on that particular day. Suppose it is nothing but the option price on 1st January 2020 and the option price on 10th January 2020. So if we add these two, then what we get is known as lock-in rate. Once again I repeat, because in this case, the available option is the options which are going to expire on 31st March. So the due date, the duration is for 3 months. It months from 1st January 2020 to 31st March 2020. So whenever you are deciding the rate, first we need to select the opening. It means the rate on 1st January 2020, future, the price of the future on 1st January 2020, and the price of the future on your transaction date. Suppose in this given example, 10th January. Suppose if the price on the opening day is 30 rupees and on the price on 10th January is 20 rupees, this 50 rupees can be considered as a lock-in rate when we are dealing. So I hope this lock-in rate is clear.
Yes, sir.
Now, generally, these currency options give more flexibility than the futures and forward contracts. Now, generally, why the options are preferred compared to the forwards and futures is this option will give a right to the option purchaser. So, same concept which we discussed when we are discussing about the call options and put options, same concept applies. Because compared to the forwards and futures, the percentage of risk involved in the options is very less. Because whoever the option purchaser is there or option holder is there, the option holder will exercise, will enjoy the advantage of nothing but to exercise the option or to what is this terminate the option. So depending upon the requirement, he may exercise it or he may terminate it. So that is a major advantage not only for currencies. It may be regarding interest rates or it may be regarding the shares also. Always options are preferred over the futures and forwards. Now, when we are entering into an option contract, I think you might be knowing the person who purchased this particular option. Suppose if you are purchasing a call option, in that case, you need to pay the premium. We need to pay the option premium. Now, generally, for calculating this premium amount and for calculating this particular option prices, if you remember, we discussed a formula of Black-Scholes formula. Did we discuss this Black-Scholes formula? Yes, Samna, do you remember this?
Yes, sir, we did.
Black-Scholes formula,
Yes.
when we were discussing about the option pricing chapter, we discussed this.
Yes, we did, yes, sir.
So we'll use this Black-Scholes formula for fixing the premium on the options and even for fixing the price of the option. So, but how we can conclude is always options preferred over the futures and the forwards because the percentage of risk is very less compared to these two. Okay. Yeah. So I think I want to stop here only because hectic, I think so. Shall I continue on now or shall we discuss this tomorrow?
We'll do it tomorrow, sir.
Okay, right. So I hope the concept which we cleared today is clear. Any
Yes,
questions?
I understood, yeah.
Okay. So tomorrow at same time we'll do it. Okay.
Okay, sir. Thank you.